Thanks so much for tuning in to this talking point, and I'm your host Neeraj Shah. And our guest today is one of my favorite conversationalists, Ridham Desai. And I say this openly on air while everybody is listening to this. Ridham, it's great having you. Thank you for talking to us today.
Well, I'll also openly say it, one of my favorite anchors. So, Neeraj, glad to be back on Bloomberg Quid. Glad to be back on the budget.
Yeah. And what did you make of it, Ridham?
So, I'll make a few points. So, when I was thinking about this yesterday, I think this is my 35th budget. So, I kind of, it gets a little bit, right? When you do 35 budgets. And I was actually going back in time. I have done 5 pre-election budgets in this, 3 odd decade period. This was the 6th one. So what struck me about this budget, I think two things. Firstly, is that it's very unlike the previous 5 election budgets that I've seen. Election budgets, when I say election budgets, I mean the last budget that the government can present to the House before the elections come. So there will be one more budget, but that will not be a full budget. That will come next year. That will be an interim budget. The full budget will come when the new government gets voted in, right? So this is therefore technically the final budget of this final proper budget of this government. So when I look at the previous 5 pre-election budgets, the political class in this country has used the final budget to unleash populist measures. So support farmers, support rural spending, give the middle class tax breaks. And that's been the tendency of the government. And this budget is very distinct. In fact, it has nothing of that sort at all. It has chosen instead to use revenues to spend on creating capacity. It's a very different budget from all other pre-election budgets. So actually speaking, subsidy spending is down in nominal terms as well as relative to the GDP, albeit from very high levels because subsidy levels did go up due to the pandemic. But the fact is that it's being budgeted to be down this year, the next fiscal. There is no emphasis on rural spending. From my calculations, it suggests that rural spending as a percentage of GDP is also being budgeted to go down. There are no major tax breaks. I think people are making a big deal about the tax rate changes for the new tax system. But the way I interpret this is that the government launched a new system of tax. It didn't quite evince the same interest as they may have anticipated, and therefore they've had to come in with with some compensatory structure in order to push people to move away from the old system to the new system. I think the new system is great, but it was just not good enough from a economic perspective. So what appears to be incentives thrown to taxpayers is really a compensation for the loss that people are suffering while moving from the old to the new system. So it's not like people are going to get money in their pockets as a consequence. And in fact, even if they get some of it, it's all of $4 billion for a $4 trillion economy. Doesn't move the needle. So you can't say this is a boost to consumption as some people seem to be suggesting. Indeed, it's not. So none of this has happened. Instead, the government has gone ahead, consolidated the fisc by 50 basis points, and reduced non-capital expenditure, or what we call as revenue expenditure, by 60 basis points, and transferred that to capital spending. So budgetary allocation to capex in all forms, whether it's ports, airports, roads, water, and many other urban development, is up um, over 30%. Now, of course, there's off-budget spending as well. So when you consolidate that, the total capex of the government will still be up on an estimated basis 17% in an election year, faster than the nominal GDP growth that is pegged in the budget, which I think is about 10.5%, and therefore it will gain share. What is the strategy here? Well, I think the strategy is as follows. We have to see what's happening in the world at large. It is a world that is slowing down this year. It's a world at the edge of a recession. Not our base call, but there is a risk. And therefore, the export impetus will be slower this year, notwithstanding the fact that India seems to be gaining market share. So it will probably do better than the world at large. But still, some of that growth impulse will fade. And the government has said, I will come in, step in, and compensate the domestic economy with some capex. so that the strength in the domestic economy doesn't go down. The other option was that you can come in and boost consumption. That would have been a little risky because we've just come out of an inflation cycle. It would have prevented the RBI from getting more dovish later in the year, and it would have created an inflation risk. So, because we still don't know where energy prices are going. So, they have very astutely not chosen to boost consumption as a means to support growth, but chosen capex, and that's why we call it a good growth budget. Good in inverted commas, which is you could choose to spend in a inferior way and in a superior way. So this, I think, is superior spending. And again, it's a function of the context. Sometimes consumption is a better way to spend taxpayers' money. Sometimes capex is a better way. In this context, capex is a better way. So you're de-risking inflation. You're de-risking global slowdown. You're allowing the central bank to end its rate cycle and get more dovish, allow more liquidity to go into the system, which is inevitably going to happen because we think the dollar is likely falling. If the dollar is falling and the RBI is rebuilding reserves, rupee liquidity will go up. So it'll be consistent to be a bit more dovish than last year. So I think this is, when I think about it, it's very beautifully tailored. Nice one. I really liked it.
Yeah. So on the headlines, obviously, one can't find too many faults per se, Rhythm. A couple of small points that I thought were interesting to talk about. On the assumptions on how all of these would be funded. Again, the subsidy cut kind of works, and you've seen the fiscal deficit come off in some fashion, which gets compensated by that per se. I thought the assumption on small savings income and the collections, was that a bit too optimistic?
Um, yeah, you could argue that. See, you could argue on a few things. Like there's an assumption on telecom revenues. There's a continuing assumption on divestments.
Divestment.
There is a bit of a thing called capital support to oil marketing companies, and then there is this point about small saving. Even if you assume that the small saving number is not reached, and the government has to increase gross borrowings, we're still within the range of what the market uh, was anticipating. So it's slightly lower than the market anticipation, which middle of the day caused the 10-year bond yield to fall, but nothing untoward about it. This is really nitpicking actually. So there is no gross violation of an assumption that could be made, and a few things here and there. And never can such things be achieved to perfection versus market expectations. But yeah, you could nitpick on small savings and say, oh, maybe you should have gone a little lower and estimated higher gross borrowings. That flexibility remains with the government, and I think it's a second half story. By which time I think it will be very clear what's happening in the world at large. The inflation picture will be very clear. We will have much more information on where the dollar is. So I think that flexibility, is there. So I wouldn't be too fussed about it.
The interesting piece is, to a lot of people, both on air and off air, over the last 18 hours, that I've asked that what would you have the budget which you think is not present, looking at the world economy and looking at the state of finances. Not too many people had too many recommendations which were missed per se, either on the fisc or on the borrowing estimates or on the tax buoyancy or otherwise. So in that sense, it kind of uh, ticked all the boxes, Rhythm, you think?
Yeah, I think it is ticking all the boxes. Tax rates are largely undisturbed. So I think that's a good thing that there's consistency in tax rates. There's a continuing move to rationalize indirect taxes. So the number of slabs in customs duty have been reduced. That's really welcome. Uh, we've been rationalizing this, and there have been intermittent spells when that rationalization was abandoned. So it's a good thing that it's being rationalized. The expenditure, as I mentioned, is in the right direction. So yeah, and I think overall the numbers seem okay. There's nothing outrageous about them, and to make us believe that these numbers will not be achievable. So yeah, it's as near a perfect budget as you can get. Also, I think there's another thing that we should talk about, which is that eventually the government is moving to an era where a lot of tax arbitrage in the system will shut down. So,
Hmm.
for example, that happened to insurance again,
Insurance.
because it has happened to the equity oriented insurance schemes. And yesterday it was done to the debt oriented schemes. Now, I think this is all par for the course, which is ultimately the government will have a system which is far more simplified and easier to understand, and will be subject to less arbitrage. And that is, the perfect way to manage the economy. So, on a lighter vein, I will say that, in fact, not a lighter vein. I'll say that first of all, the documents were very simple, and I was done at 2:30 p.m. And that's such a, this is a welcome change,
Refreshing change.
versus 10 years ago, when, when we were inundated with complexity in the fine print. And I would refuse to actually make any comment, because there would always be some fine print that would surprise us positively or negatively. And it would be hours before we got to that. Yesterday, there was no such thing actually. And there were a few things in the details, but nothing dramatic for us to, for me not to, say, okay, I'm done. I've read the budget. I've understood what is happening here, and I can move on. So
There's
yeah,
some
simplicity. Yeah, simplicity
simplicity.
is certainly a good thing that we have managed to achieve with our government budget.
Mm. There's some, and well, so as near a perfect a budget and simplicity, I don't think you could ask for more. My question is, so two quick questions from a market's perspective, and then some texture on the market. One, there's some conversation going around whether P notes make a bit of a comeback through Gift City, and I heard opposing views of the same. Do you have any thoughts here?
No, I don't think that's the case. See, I think the gift city is a instrument that has been designed to bring back India's capital markets onshore, which have got exported over time, right? So, in order to make that structure competitive, it was important that the offshore derivative instruments that get issued in gift city are honored as contracts on Indian territory. That doesn't mean that offshore P notes, which are issued outside India, make a comeback. Okay, so I think we should not mix up these issues. This is not the same thing. This is about making Gift City a viable place uh, for capital market activity that has historically happened offshore. And I think it's good that the government recognizes that not all market participants are willing to operate onshore for various reasons. It's not like people want to evade taxes or they want to avoid the system. They just don't have the systems to deal with all this. Smaller entities just don't have the back offices to deal with it, and therefore they prefer to trade offshore. Now they have an instrument to trade offshore, but technically onshore. So I think that's what the Gift City has been prepped up for. So these were a few final things that were still pending. And I think it's a very good thing for India overall from a macro perspective that we are actually bringing our capital markets back onshore. So I don't think it has anything to do with P notes. That's my view. It's all about making Gift City a viable offshoreable operation.
Hmm. Okay, thanks for that understanding, Rhythm. The other thing is one small errand that a few people thought, I mean, wealth guys would have thought of it as a big one, but even people who are not quite associated in doing that business said that a lot of these market linked instruments, which are, uh, oops, okay, never mind.
Yeah.
A lot of these market link instruments, which are getting corrected, if you will, it happened to MLDs yesterday, are happening piecemeal. And there are a bunch of other products which are also, I mean, there is a thought that FMPs kind of could be on the block next. But why is it being done piecemeal? Why can't it be done in one go? Why can't be there a discussion paper and then try and do it all in one go so that there is clarity? Any thoughts that you have on this?
Yeah, fair enough. I mean, it would be ideal, but I don't know if you can actually do a comprehensive paper. And I'll tell you why. Because the market is always one step ahead. You fix something, the market will solve for it and do something else. So, the government always will be one step behind the market. It cannot anticipate everything that the market will do. So, it'll never be solvable in one go. And that is, I think, a dream outcome. It will never happen because even on this insurance thing, uh, there will be some solution that insurance companies will come up by, and then that solution will come into play, and then 3 4 years will pass, and then there will be further examination, and then the government will think, okay, are we again bringing in some tax arbitrage, and do we need to address it again? So this is really how markets function, right? They solve for things, and the market is always trying to improve returns.
Yeah.
Or market participants always trying to improve returns and looking for loopholes in the tax laws in order to capitalize on them, and then the government has to come and plug them. So yeah, you can say in theory, yeah, why don't we do all of this together? But it will never happen.
Okay. Okay. What about the market itself, Rhythm? The last few days, for not reasons maybe aligned to the budget per se, because now I fail to believe that a pre-budget down move comes because the market anticipates that there could be tax tinkering, because this trial balloon has floated now for 3 years on a trot. I've heard stories about tax tinkering for 3 years and it don't happen. I hope the market does away with that. So there's a bit of Indian markets are not quite moving in sync with what the global markets did. They didn't do that in 2022 either, you would argue. My question
Yeah.
is, what's ahead?
So see, I think, Neeraj, you go back to the end of October. India was outperforming emerging markets in 2022 by then by a magnitude of over 30 percentage points. It was a staggering amount of outperformance. And the final 3 months of that outperformance line was something like this. It was a vertical line. Valuations were trading at two standard deviations above average. And my regional strategist, Jonathan Garner, very presciently went underweight India, because not because he was bearish on India, but he turned bullish on Korea, Taiwan, and China. And his rationale was twofold. One was that he thought that a lot of the bad news that was coming on the global front was in the price. I think Korea in October was trading at something like 1.1 time book. The valuations were way below average levels, and he thought it was a good risk to go and buy Korea, Taiwan, and China. And to fund that, of course, these are the four big markets in the EM context. He went underweight India. So that is a call that I think resonated with us, because we realized that it was not possible for India to support these relative valuations if the denominator, which consisted of Korea, Taiwan, China, were improving. Now, if you look at what the market has done in the last 2.5, 3 months, is it's given a bulk of India's outperformance that it had registered in the first 10 months of 2022. We are now down to, on a cumulative basis, from Jan 2022 to mid-single digit outperformance. The relative valuations have also corrected. So India has, I think, come back to a situation where things are now looking a little less exuberant on a relative basis. The absolute case for India is intact. Okay, my view is that earnings growth this year will be better than what the consensus is forecasting. And my top down estimate is 10% higher than what the consensus is saying. Last year, I was below the consensus. Last year was not a bad earnings year.
Yeah.
It was a good year in a relative context, but it was a slightly less attractive year compared to what India Inc. did in 2021. Raw material costs went up, revenue growth was still strong, margins went down very hard, and profit growth slowed down meaningfully. I think the reverse of that is happening this year. Revenue growth, I think, is slowing down, because global growth is slowing down. So India's GDP growth, we reckon, is going to be slower than last year. Therefore, revenue growth is slowing down. But profit margins, I think, will improve. On a top-down basis, it's because capex will be strong. On a bottom-up basis, because raw material cost will be less punitive compared to last year. So I think overall the earnings template looks good. The relative valuations are still adjusting. Normally, when these things adjust, they do get into oversold territory before they come back. So India's relative performance, I think, will take a little while to turn. It's not yet ready for a turn. The absolute performance, I think, should be pretty okay, because if EM is doing well, and if we are right about EM, and our regional strategist thinks that EM has entered a new bull market, so it's inevitable that with a little bit of lag, India will come back. So I think we're kind of consolidating here, and just preparing for the next up move. So I remain constructive on the markets on an absolute basis, a little less so on a relative basis, and that's been how we've been thinking for the past few months. Now, just
Yeah.
one idiosyncratic issue on India is, as we go into the fourth quarter of 2023, the market will start um, predicting what the general elections will bring. And if the market starts believing that another majority government is getting formed, then I think you'll get a fierce rally into the year end. It's quite likely that well before elections actually start, the market would have priced in what it believes to be the most central outcome. And of course, if the market starts believing otherwise, then it will falter. So the factor driving the market will move away from fundamentals. For now, I think the fundamentals look pretty solid. The
Hmm.
key risk, as I said at the outset, is global growth slowing down. To some extent, we have mitigated that risk with this budget plan. So, if well executed, I think we'll probably have better than expected growth, at least versus consensus. And my earnings number will be probably more realistic. And I think that's the template to think about the market. So, for longer term investors, I think all of this is not relevant. And really, if you're in equities, you should be a long term investor. For people who are trading this and living off trading income, I think they need to think about timing and all that, and maybe the time to buy is coming from an absolute basis.
And the few points are rounding off errors, so I won't get into that. Rhythm, so I don't remember dates as well as you do, but if I'm not wrong, it was Jan 2021, wherein I read a note from you and your team. It said, back up the truck and load financials.
Yeah,
I got it right. My question is
I think
therefore,
It was February 21. Yeah, it was
uh,
February 21. Yes.
okay, never party early. But be that as it may, I meant myself that I said that I got the date right. That's what I was referring to. So don't
Mhm.
rejoice early. So my question is, from here on, if indeed earnings were to go as per what you are believing, uh, but if banks have potential NIM compressions ahead, if you will,
Mhm.
do banks, do IT, and maybe do autos, some of the heavyweight sectors, do they contribute, or do we see the contribution coming in from unexpected quarters, you reckon?
So when we wrote the Feb report, I took a lot of pain and a lot of criticism because in the subsequent 2-3 months, financials actually didn't do well. It was only when I think it was only in the second half that financials soared. Um, I think the case for financials remains intact. Within financials, you may move your portfolio around a bit. So you're spot on. There is a bit of NIM compression coming for banks because deposit costs rise with a bit of a lag. But the opposite is true for the non-banks because they have taken much of the pain in terms of their borrowing costs. Since their borrowing costs reprice a lot quicker than banks because their average maturities are lower than the bank deposits. So for non-banking lending businesses, I think this year they will see stabilization in NIM, maybe a slight uptick, strong credit growth, and low credit costs. So I think they will do quite well. At least in this earnings season, we're getting a bit of sign of that as well. So they're surprising on the upside, which essentially means that the consensus was probably a little too bearish. And I think those are the stocks to pursue for 2023. The banks also, I think, will be okay because credit growth, in my view, still remains strong. Notwithstanding the slight NIM compression that they go through, they will still have strong earnings. So overall, I think financials are still in a good place to be. You may just shift the portfolio around a bit from last year. Um, I have been bullish on tech, right, wrong all the time. Um, we had a debate with my analyst because he continues to be a little cautious. But I think that at least in the autumn, the tech stocks were pricing in more than what was coming in terms of a slowdown. Now, since then, they have made a bit of a move, but I continue to be overweight tech because I think that the U.S. recession or the U.S. growth slowdown, we are not predicting a recession, may not prove to be as punitive as in previous cycles. And this is actually also related to your earlier question on India's outperformance and underperformance, which is India has become a lot more defensive than it used to be thanks to three things. One is inflation targeting. So we're doing a whole lot better because of that on macro stability. The second is the focus on FDI versus FPI. So FPI has always been more sensitive to global macro, US growth cycles, oil prices. So if you look at India, it's the market's sensitivity to these things has reduced because the macro does not depend on FPI to fund the current account deficit. It is more reliant on FDI, which tends to be a whole lot more stable. And the third is the creation of domestic risk capital, which started in 2015 when the government allowed retirement funds to invest in equities and has been since building. And I don't think this is going to stop anytime soon. So these three things have made India a lot more defensive, which is why in 2022, when the world was wobbly and was suffering, India was okay. And now the world is looking like it, wants to get more optimistic, and India is, taking a little bit of a backseat. It's very sweet for Indian equity owners, right? Because this is exactly what you want from your stocks, right? That they should not do as badly when the chips are down, and they should do okay when the chips are up, and that's how India has become. So this is the overall context here. So financials and tech, I think, still look like good places to be, and I'll just add to to the answer here before you ask, which is I think industrials also do well, and many places in consumer autos you referred to, I think, are still okay. We should see pretty strong auto trends for the course of the next 12 or 24 months.
Okay. My final question, and which is because the budget has also not quite been that rural focused budget, freebies not being doled out. Do you believe non-auto, so non-discretionary, non-urban consumption is on the back seat for the rest of the year until some things change?
No, actually, I don't think so. It would have been advantageous had the government put some money to work there for those companies or sectors. But the terms of trade for rural India have clearly shifted, and the government has acquired paddy in a very aggressive way, so has clearly neutralized the loss of paddy production that happened in the last summer. The winter crop looks very strong, and I think that rural India will bounce back pretty nicely this year. So I would continue to pursue the stocks of companies that have got rural focus, and I think you will slowly get it in commentary also of companies that are more rural oriented. So it's a natural cycle with or without government support. Government support would have caused the cycle to turn much faster or much more aggressively, actually not faster but aggressively. But the natural turn in cycle is happening, and rural is making a comeback.
Great. Ridham, always a pleasure talking to you. Thank you so much for taking the time out today as well, and look forward to talking to you more.
Same here. Thank you for hosting me.
The pleasure was ours, and viewers, thanks for tuning in.